I'm always bummed because I'm just like, you're boxing yourself out of opportunities because of the way you're pricing. And I always feel like price should never be the reason why people aren't doing a deal. Like it should be for like real valid like thesis reasons. And like I'm seeing a lot of interesting stuff where I'm just kind of like bummer that this isn't gonna work for most funds simply due to price. Thanks for having me. I'm excited to be here today. I can give a little background on myself. I am a partner at a fund called Habitat Partners. To give a little backstory of my journey into consumer investing, which definitely is not linear or traditional. I was at a big CPG enterprise to start my career called PepsiCo that everyone has definitely heard of. I was within corporate finance within the global division at a time when we bought a kombucha company called Kavita. I was always very passionate about health and wellness. I was a college tennis player. I know you were a college basketball player. And so that really drove my passion for food, for beverage, for all these things that I was kind of putting in and on my body my entire life, both as an athlete and then even post college. I was always like a fitness enthusiast. And so I completed two more roles kind of in the big CPG world. I was leading the P&L for a US water business called Evian under the parent company Danone, and then cut my teeth more on the brand strategy marketing side at AB InBev, where I was within the global brand marketing division working on special projects for brands like Budweiser, Corona, Michelob Ultra, and Stella Artois. And then in my final role at AB InBev, I was leading our global innovation team, which really consisted of taking new launches all the way from concept to commercialization around the world, which was a really fun role. Had a kind of reflection that I wanted to be closer to the early stage world and really be part of stories in which case emerging brands were disrupting kind of the typical CPG enterprise model. And I saw a lot of brands kind of successfully doing that during my time at CPG Enterprise. And so got the opportunity to work for a fund manager that started his fund up in San Francisco. That's Kiva Dickinson, Selva Ventures, and learned the ins and outs of venture from him. Kind of fell in love with the space. Felt like all of the operating kind of experience I had had going into the role was really helpful both in diligence and also in terms of supporting founders within the existing portfolio. I then went and did an MBA at Stanford where I kind of continued to double down on venture, learning the ins and outs in Silicon Valley. I also got some really interesting exposure to the software world, just being up in that kind of part of the world. And, I'd seen these B2B SaaS tools that founders were using within consumer when I was diligencing D2C businesses, and also was really interested in that side of the coin. And so during my MBA, angel invested, led SPVs into a bunch of different startups, both on the consumer and the B2B software side, mostly marketing tech, retail tech, commerce tech on the tech side. And then I had co-invested with Habitat Partners in one or two things, and was reconnected with Blake, who was managing the fund post MBA through a mutual connection, and we hit it off and had really complementary skill sets. And I ended up joining him after my MBA.
Well said. A lot in your background there that you unpacked in like 3 minutes, but let me just high level that. So it's right out of college, you went into enterprise CPG.
Mm-hmm.
That's where you spent the first few years of your career. So you weren't an investor before that. You kind of just learned the
No, I
operating side of the
mean,
coin.
there was a lot of really, big companies train really well on like technical skills and just like basic kind of skill sets that are important for conducting analysis. And so there was modeling, there was PowerPoint presentation building, there was just a lot of kind of base skills that I felt like I was able to learn in a really like structured manner within enterprise world. I think that's like the pro and the con of enterprise is everything is structured to a T, whereas obviously in startup world it's very unstructured. But definitely felt like having like the enterprise training gave me a good set of just like base analytical skills that I've definitely like been able to carry with me throughout my
Yeah,
career.
absolutely. And I'm sure that helps you connect with operators that you're in conversations with. And
Yeah.
it's a nice foundation to build off of. And then You mentioned Kiva and Selva Ventures, which I think is one of the best early stage firms in consumer. And if you don't follow Kiva's content, check him out. He's always posting stuff that really opens up the industry, and he shares all his knowledge. So he's great. That must have been a nice place to pick up
Yep.
for
Got
you.
to ask him a ton of stupid questions, and he's an awesome mentor, and like yeah, they're a great fund as well.
Yeah. So, all right, let's bring you up to today. You're an investor at Habitat Partners, which is an
Mhm.
NYC based early stage venture firm. And you also run your own newsletter called Term Sheet Pitfalls, which, again, if you haven't seen this, subscribe to that. It's really insightful on how founders can and should approach funding negotiations. So, just bring us up to speed on what you're doing today.
Yeah, 100%. Thanks for the kind words on the newsletter. Obviously, a big reader of Paperboy as well. And I'm featuring Paperboy in this week's post. So there you go.
Hey, now check it out.
Yeah, so our fund is a seed stage focused fund. We kind of focused on two separate strategies, one on the technology side and one on the consumer side. Within CPG, I would say we kind of own an earlier space than most funds. I would say that from 2021 until now, many funds have kind of moved to the Series A plus stage, late seed phase.
Right.
And we're very committed to going earlier than I would say 99% of funds. And so, in the last 2 years, we've invested in consumer brands pre launch in a handful of cases. We also very commonly look for brands that are within kind of the $1 to $6 million revenue range. So we have done traditional seed investments as well. Typically, if a brand is beyond 10 million, it's too far gone for us. So we're not really looking to do much in terms of brands that are looking to raise at any valuation really above 25 posts. We try to really even keep it within 15 posts for the most part. We feel like that's a point of differentiation compared to most funds, like I said, have moved later. Within CPG, we're open to food, beverage, beauty, personal care. We don't really do apparel or retail, but we really do like to do food and beauty for the most part. And so, yeah, that's kind of the parameters for our CPG side. It's typically a check ranging from 500 to 750K. In the earliest stages, we can also flex down to 250K if it's a smaller round. We have led some pre-seeds. However, typically we don't lead with that check size, considering rounds are often, up to 2 million and even more in seed stage. And pre-seeds occasionally we have led. Don't really take board seats as well. We have a pretty big portfolio that we try to give a lot of attention to across the board. And if we were taking board seats for a lot of these businesses, it probably wouldn't be a good use of time. And
Sure.
then in terms of technology, we do a lot of B2B software that really empowers brands. So brands that are using different technologies to better acquire customers, to better market to customers, to better retain customers, the selling experience, and so on. So I'd bucket it as marketing tech, retail tech, commerce tech. And so that's another focus for us. We're again seed, pre-seed investors in that bucket. And then we have a third focus, which I would just call opportunistic technology. A little backstory on our fund is two of the partners or the co-founders of Red Antler, the creative agency that was started in Brooklyn in '07. So we have a lot of kind of just interesting relationships with founders across all different sectors that we have the benefit of accessing. And so occasionally there will be a founder that we have a relationship with through Red Antler that we have access to for their financing round. And so if we really have a strong positive feeling or conviction about that founder, irrespective of the sector, we will opportunistically potentially write a check into that founder's business if it's in climate tech, robotics, insurance tech, fintech, et cetera, et cetera. So that's also kind of a deliberate strategy we also have under the hood.
Right. Yeah. Makes sense when paired with the types of businesses that Red Antler comes across. So being opportunistic allows you to
Exactly.
to see
Exactly.
the
We're
best
we're
that's out there.
focused, and I'd like to say like we're domain experts when it comes to CPG and B2B SaaS, but then we also have this ability to be flexible and opportunistic.
Gotcha. Okay. So for the rest of this conversation, let's leave robotics aside and all the tech
Let's do
aside. Let's
it.
focus
The
focus
boring
on
stuff. Get
consumer.
rid of it.
Yeah. Yeah. The stuff you can feel. We're
Yeah.
gonna we're gonna talk food, beverage, beauty, personal care.
Yep.
So well, let's start with the seed stage focus. And I think you defined that really nicely. Anything from pre-revenue to 10 million in revenue, and you're targeting that 25 million post. can you just talk to us about why that's the focus for this fund in particular?
Yeah, I mean, I wouldn't necessarily say that we have really strict ownership targets. But I'm a big believer that obviously, like, if you can get in with decent ownership stakes in capital efficient businesses, obviously your return profile, if things go well, is going to be strong as possible. Whereas if you're not able to get good ownership and you're going to be diluted pretty heavily along the way, then obviously it eats into your return. And so with our check size, which again could be anywhere from 250 to 750, if we want to try to get 5% of a business with that kind of check size, it requires us to keep valuation relatively low. And so that's like the starting point logic. And then I think just going back to the comment I made earlier, when we think about our competitive positioning within the CPG landscape, again, I think for better or worse, I mean, I can completely understand why funds have done this over the last few years, but it feels like a lot of funds are really scared to go early. And so they've really gone past the seed phase into the Series A plus phase, which again, it's never been easier to start a CPG brand in general with just like Shopify and all of the resources available, even though capital is scarce in the early days. And so I think for a lot of funds trying to pick companies in that early stage when there's so much fragmentation is extremely difficult. And so that's pushed people to go later. But we feel like by staying within this early phase, we have a point of differentiation against most funds. And I also think because our team has quite a wide array of kind of cross functional knowledge, like I'm more of a cash flow supply chain ops finance person, but my partners are very creative minded as co-founders of Red Antler, and so when it comes to really thinking creatively and strategically about like what a brand can mean to a consumer in the earliest days, I feel like we do have a really unique perspective when kind of deciding who to partner with, and that's probably the third reason why we're really comfortable going early, and we've been pretty deliberate about staying earlier than most.
Yeah, so I want to get to that and hear about how you and your partners will look at a business and what stands out. And it seems like you have all of the operating verticals covered. So
Yeah.
team effort, weigh in and figure that out. But just
Yep.
back to the ownership targets that you mentioned. So is that what you look for? You look to get like a minimum of 5% up to
Yeah,
15.
I mean, it's impossible to be perfect, right? Like, there's always just variables. Something is a few $1 million higher than our ownership target. 5% is like our average target. There's certain businesses where we've owned more closer to 10% by investing in a pre-seed round. Then there's others where we've owned a little bit below 5%. But yeah, I would say give or take like a few percentage points above or below is kind of what we're looking for. And yeah, I mean, we'll flex up our check size if a company is a little further along and is demanding a little bit higher evaluation. And we can flex down our check size if it's, a pre seed that's getting done below six posts as well. So,
Makes
yeah.
sense. And you mentioned that the firm's focus is really on food and beauty. Sounds like you mostly have a beverage background, which is interesting. Is that PTSD from your beverage operating days? Is that
Yeah,
why you
that's
don't
a
go
great
that route, or
question.
what?
Yeah, you know what? I think for the venture model, there's kind of two camps of investors, and I think some investors are very comfortable with huge outcomes with lots of dilution and underwriting to that kind of path. And then there's other investors who are a bit more targeted around surrounding capital efficient businesses that don't need to raise tons of capital to get to the finish line. And I'd say I'm a little bit more in that camp just because you never really know when capital is going to be available versus super scarce. And if you're a business that's reliant upon tons of it, during your journey, there's definitely a bit of gambling and rolling the dice occurring compared to someone who can be more self-sustaining. And so fundamentally, right, like the beverage business model requires a ton of capital. It's expensive to ship liquid, out of pocket price points that are being put at retail are low, and so it's the kind of thing where no matter what, you're gonna have to raise a pretty good amount of capital to scale a beverage business. Now, I think conversely, what we've seen with Poppy, obviously, Alani Nu, Ghost, and some of these exits recently is that the TAMs for the beverage categories are absolutely enormous. And so you can certainly be rewarded, even though you're absorbing dilution along the way with a huge outcome. I personally, I just don't like that pathway as much as I like the more capital efficient pathway. And so I've been more attracted to food and beauty over the years just because I get more comfortable with that capital efficient pathway than the burn a lot but become huge pathway. It's not a right or wrong answer. It's just my personal preference and the kind of businesses that I like to underwrite.
Yeah. Yeah, no, it's an operating preference, and I think I don't know if you saw it. You probably saw this last week. I think it was Gorgie that
Yeah,
raised like 25 million, and
lucky.
Lucky did the
Yeah.
same thing, and they're on that path
Yeah, and I
of
think
just
I think two very interesting brands and great investors behind both of those brands. I think the tough thing there too is like you have to inherently absorb pretty poor valuations and multiples in a lot of those cases with brands like that because in order for the founder to not get incredibly diluted to the point where they're demotivated, there has to be a high valuation to absorb all that capital, right? Without too much dilution. And so you end up paying up for brands as such when their revenue isn't really there.
so you're overpaying in a
You end
space
up
like
having to
that
overpay to
versus metrics.
capitalize exactly to capitalize the business in the manner that those two brands have had in the past, and it's not necessarily a bad thing. Again, like those can be huge outcomes, and all of this. Then I sound silly saying this, but not my style personally. But look at Liquid Death. I mean, if you were in there early and there's tons of capital raised along the way, you'd probably still be happy with where it's at now, even though they've burned a lot and still are burning a lot. So
Yeah, I'm a fan. This is actually a Liquid Death shirt that I'm
love it.
wearing right now.
LD.
So yeah, so nice reference. But okay, so that aside, let's talk about food, because
Mm-hmm.
that's a common category that we go deep in at
Yep.
Paperboy. So when you're evaluating a new prospect for investment, can you kind of walk us through your philosophy on what you're looking for before you get to valuation? So, like,
Yeah.
let's talk about just the core attributes of the business.
Yeah. I mean, I'll talk about businesses that I guess have a little bit of traction just because I think the diligence process for a pre launch is a little bit different than a process for a company that's between like 1 to 5 in revenue. But
Sure.
I'll go in the camp of 1 to 5 in revenue and just very shortly say if it's pre-launch has a lot just to do with founder white space, competitive landscape analysis, and a little bit of auditing of co-man contracts. But let's say a brand is just post-launch and does have a little bit of traction. Like, what am I looking for? I would say there's both quantitative variables and qualitative variables. So on the quantitative side, I think the most literally important thing in all of CPG is gross margin. All in gross margin, so including fulfillment, warehousing costs, both freight in and out. I look for brands that are doing at minimum all in gross margins above 30%, ideally 35%, but like 30% is where like I'll continue to look at the business further. And I just think that metric, like people obsessed with velocities and people obsessed with sales growth, I think gross margin is the most important metric in all of CPG. And if you think about what is fixable if a strategic acquires your business post M&A? You can cut operating expenses and overhead and absorb those synergies, but fixing gross margins is almost impossible materially without compromising on the product quality or experience. So if you don't have gross margins intact in the early days, sure, can you improve them by, a couple percentage points a year over time? Possibly, yes. But if they're just fundamentally flawed to start, you're just going to get into a vicious cycle where you're just not dropping enough dollars to the bottom line for each unit that you're selling. And ultimately, strategics really, I mean, if you get there, aren't going to be as excited about acquiring your brand because there's not a whole lot they can do about gross margins either without making your product much worse, different, cheaper ingredients, lower quality, and so on. So gross margins like number one.
With
I
within gross margin, if
Yeah,
we could pause there for a second, are you, because food versus beauty is much different. Are
way
you
different.
you're looking at that in context of the category, right? So you're
Totally.
just
Yeah, you
looking for the
nailed it.
best.
You nailed it.
And what how do you I guess how do you benchmark that? Are there sources that you use, or is this
Yeah,
just from
I mean,
seeing
I
lots of stuff?
think I think after you see enough businesses across subcategories within each food, the food side and the beauty side, you start to just get a feel for like what is good and what's average and what isn't. And so like 35% is like pretty solid. I don't see very many brands that can do it in the early days, and some investors will be comfortable with 20%. It just depends what kind of like investor you are. Like I care a lot in the early days about hitting that 35. For others, they'll understand that that's almost impossible for certain categories, and they're comfortable with that. Almost impossible in beverage. I know we're talking about food, but on the beauty side, it's a different ballgame. So like with skincare, I would say 70% is like very solid. With body care, I'd say 55% and up is really solid. So yes, it definitely changes as you shift into the beauty side. And then I would say beyond gross margin, I personally, and again, this is a personal preference, I like to see at least one proof point or an imminent proof point of retail success. Some investors are super comfortable with being D2C for several years. Like I personally like investing in brands that either are already in a retailer with proven velocity, or at least are on the verge of launching in several retailers that I feel excited about. And within that kind of retailer proof point piece, I think it's much better to have a proof point in a more conventional retailer than it is in a premium natural retailer. Like I've definitely seen brands bring data on Whole Foods as like their main case study. And for me, that's actually not that exciting. I think, consumers walk into Whole Foods in looking for discovery and, trialing new products and seeking innovation. They also don't really have much sensitivity from a willingness to pay perspective. And so I'm actually less impressed with Whole Foods and Sprouts than I am with like an HEB, a Wegmans, or even a club account where you're doing really well. So
Is
within
that
retail, I look for retail proof points, and ideally, if there's both conventional and natural premium, that gets you more excited than if it's just natural premium. And then I would say beyond that, like D2C is important to the extent that you have good repeat purchase, but I don't really believe there's that many businesses within food, with the exception if you consider supplements like BMS food, that really are meant to scale on D2C. Like retail is where you win in food for the most part. And so well, like I'm excited to see strong repurchase rates and retention within D2C. It's not as important as seeing retail success with obviously solid velocities, and then again channel mix within retail being a blend of both conventional and natural premium.
Yeah, and your point on conventional, I imagine that's because the objective is to see these brands scale into the mass market in the US. And I don't know if you have like a specific when you make an investment, do you have a target exit price that you're thinking about at that time, or
Yeah.
how do
So
you go about
we,
that?
yeah, given that we come in, somewhere between 10 to 20 posts, our goal is to get like at least a 13 to 17x. So that could really range from an exit being anywhere from 200 to 400 million, let's say. I typically underwrite to 300 million as like my base, but we have the flexibility of like getting a $200 million exit because we're coming in so much earlier. Like that's still a great outcome for us. But yeah, 300 million is kind of like my bread and butter CPG exit that I underwrite to.
Gotcha. Okay. And so you mentioned gross margin being the most important, the retail traction being second. What else comes to mind when you're going through and validating a new
Yeah,
brand
for
to
sure.
invest in?
So we talked about retention and like kind of D2C metrics. Like I would say beyond retention, like first order profitability online is a huge plus, especially if D2C is going to be a big part of your business. Then I would say, and I guess this is a bit more qualitative, is just like, are you solving a real consumer problem, an incremental consumer problem that isn't very clearly being solved by existing brands today? It's getting harder and harder to like truly answer yes to that, as we see the fragmentation of so many different parts of the grocery aisles. But yes, competitive differentiation and solving a real consumer problem that I feel like is important to a wide array of consumers across the United States is like another piece of diligence that's quite important. Like when we invested in AO, which is a mayonnaise business, there's obviously Hellman's. I didn't really feel like there was like a better for you challenger, exciting brand that had really like penetrated the mayonnaise category within the category as a whole. Obviously, like there's Duke's Mayo that just recently traded, but for the most part, I felt like it was a part of the shelf that like lacked innovation and new entrants over the years, and so that's an example of where like I felt like for the most part, like the competitive landscape was rather weak. But finding that kind of company that's tackling a white space is definitely more challenging these days. And then I think like outside of competitive landscape, there is a total addressable market analysis to be done. It's not to say that unless it's an absolutely massive total addressable market, we're not investing, right? I think there's plenty of examples of brands that have created new categories or taken people who have abandoned a category back into a category. Like I think what's amazing about Olipop is not only is it a huge, huge TAM, right? But I think there are a lot of people who abandoned soda because they just felt like it was too unhealthy, and now they're coming back into the category because there's such a superior solution available between Olipop and Poppy. So we want to see like a big market, but if it's not the most massive market in the world, it's fine as long as we feel like there's a pathway to the business getting big. And again, that can involve bringing new consumers to the category, abandoned consumers, and so on. And then I think the last thing, and it's so important, especially in the early days when there's just less traction data to go off of compared to the Series A plus rounds, is the founder. Um, I look for a few things in a founder. Like one, I don't necessarily believe that the founder needs to be solving a problem in their personal lives, which is a little contrarian. Like I think some investors are, oh, like, this person had a gluten-free allergy, so they have the right to build a gluten-free pasta. I don't know, I'm just making something up. I would rather have someone who's worked at a pasta company for 15 years and knows every retail buyer and knows the ins and outs of the industry than someone who like has this personal passion story about the category. So I look for really product market fit experience is what I kind of call that. And then the two superpowers that I kind of look at within a founder is like, can they generate organic virality in the early days? Like, do they have a very creative kind of skill set when it comes to brand? And secondly, like, are they experts at managing cash flow and owning a P&L? Cash is so precious in the early days. So if you don't really have a really, really strong hold on all the different lines of your P&L and kind of what drives burn, it's going to be really tough. And so I look for founders who have one of two of those qualities or both, in addition to kind of what I mentioned surrounding like founder market fit.
Got it. So yeah, that's sort of the qualitative side to the coin,
Yep.
which we're talking 1 to 5 million brands. I imagine if you're pre-revenue, you're just weighing those heavier, and you're looking at really just the total addressable
Yeah.
market, the founder, and then the concept.
Yeah, that's right. I mean, I'd say you're still looking at it post traction, but I would say the importance of those, obviously, of those qualitative factors just goes up to a new notch when you're pre-revenue for sure.
Sure. Okay. So say you have a brand that checks all those boxes. Let's talk
Mhm.
about your process and what you do next and how you actually come to a valuation on these companies.
Yeah, well, the one thing I would also say in the interim is like I would start at the end running some reference checks. Like if I feel really good about the founder, I also want other people who have worked with the founder to feel incredibly strong about the founder as well. So that's one of the final big steps as well as like reference checks, especially in those early days where you don't have a ton of quantitative data, are super important. But yeah, landing on valuation. So I would say like in the pre-seed phase, because you're not really trading on real multiples because there's basically no revenue, it's kind of just a feel for where the market is from a comps perspective. I've always said within food, like 5 post is kind of like the average for a concept that is really, really strong, ready to go to market, might have a few anchor retailers, like is built up like a big waiting list, already has a social presence, et cetera, et cetera. I would say for brands that are like very much like an idea on paper, like even going down to 3 or 4 posts is relatively reasonable. And then I would say for like a brand that is like launched in a real retailer, has some like actual velocity data that's like really strong, has more retailer launches imminently like on the horizon, has built out like a pretty solid co-founding team and just has a few more like traction points even though it's still like a sub-million brand. That's where I think like it is feasible to go up to a 6 or a 7. But that's kind of the lay of the land in the pre-seed world. I would say round size is also going to dictate price in that if someone wants to raise $2 million, I mean, they're going to give away what, 40% of the company if it was a 5 post. So, I think if a round has a lot of demand and it's somewhat sizable, just to keep the founder hungry and motivated, sometimes that'll push price up a bit as well. But if it's in $1 million round in a pre-seed phase, I think 5 post is kind of like your middle range.
Yeah. How how are you looking at, like, do you look at sales multiples at exit, EBITDA multiples at exit, and then try to bring those into the conversation, or like what do you use as an anchor to?
Yeah, I mean, there's definitely some of that. Like you start to see how later stage assets are trading, and maybe that dictates a little bit how you think about like the early stage environment as well. I mean, obviously the quality of the assets in the latest stages are like insanely strong. And in some cases, right, like strategics are willing to pay up quite a bit on EBITDA multiples, and at that stage, also these businesses are really cash flow generative and generating an EBITDA, and so trading on both revenue and EBITDA. Whereas in these early stages, there's none of that. So I don't necessarily think it's like the best guide. I really feel like the best guide is just what you're seeing in like the current market environment that you're trading in within the early stage, and so I'm pretty close with a few other investors that really invest early. And so we do have kind of a feedback loop with each other as to like what's reasonable in the current conditions. And I think what's kind of like interesting for us is like, because we also invest in tech where valuations are just honestly insane right now, my desire to like pay a premium within CPG is probably just like much lower than other purist CPG investors, because I need to kind of diversify and hedge the fact that in some cases in tech I'm going to have to like pay up from a multiples perspective. It's just the nature of the game right now. But I feel like conversely, to kind of counterset that within CPG, I never want to pay up, and so I may be even like a little bit cheaper than some of my co-investors in the CPG space, just because they don't have to worry about kind of fighting these tech valuations that we face on a weekly basis.
That's really interesting. So from your lens, it's much more competitive on the tech side of things to get into deals than CPG.
Yeah,
Has that shifted at all in recent months with these big multi-billion dollar outcomes in beverage and a couple others in food?
I think for the Series A plus phase, it's relatively competitive because, again, I think everyone's moved up market a little bit over the years. Like I said at the beginning, I don't really feel like in this pre-seed seed neighborhood it's that competitive. I'd say again, there's 4 or 5 like real institutional funds who will play like this early. There's definitely some like bigger funds that are creating little pockets of capital to dip into kind of like the territory that I'm in, which is interesting. I have like some thoughts and feelings around that. But because again, there's such a scarcity of early stage capital in CPG, I wouldn't necessarily say that it feels like super competitive, even though the exit environment has been really, really strong. I think what'll be interesting to see is if some of those tech funds that like left CPG after the D2C heyday like now start coming back. And if those guys start to dip into like seed and they're very valuation insensitive, I think then it could get problematic. But to be honest, the only like example of that I've seen recently is like a tech fund coming back into CPG growth equity. I haven't really seen it in the
Yeah,
earliest
go into the
stages.
seed stage. And I've
Yeah.
seen the same thing. That's part of the reason why I started Paperboy, was to support the early seed stage
Yeah.
funding that has fallen off a cliff. And,
Yeah.
if you think about the future of food and beverage in this country, it's going to look a whole lot different in 10 years than it does today. So there are going to be winners, but the curation problem at the bottom of the pile is, I think, the most challenging thing at the early stage.
100%. And I wish I had an answer. Like, I feel like when I appear on podcasts and speaking engagements, it's like, what should earliest stage founders do to like raise capital? And I'm like, I mean, it's tough. I don't know if I have like the silver bullet.
Well,
I
for
yeah,
one, I think pitching venture funds is probably the wrong thing to do,
I agree.
because, like you said, there's only a couple of them that are out there. What I see working, it's angel groups, individual angels,
Yep,
family offices, and then just people that are close to you in
that's
your
right.
network, because you're betting on the person, and your highest chance of succeeding is
Yeah,
to go for people that know you.
and even that's right. Easier said than done, but I 100% agree. That's kind of got to be the path in the earliest days, and then I think assuming that you can't raise a ton kind of from that path, you just have to be extremely scrappy and patient about how you grow before you're ready for those venture funds, because you just can't burn too much of that cash too quickly before you hit the milestones that would make you attractive to some of these institutions from
Right.
from a guideline perspective.
So just to wrap up, if founders are listening to this and trying to understand the best way to approach a group like you with evaluation in mind, is that what happens in your state? Do you get a pitch from a founder and they say we're raising at an 8 or a 10, or do you just get a pitch and then you come to evaluation with them?
It definitely goes both ways. I think inherently founders usually try to come with like a number to anchor the investor, which is like, that's fine. I think that like ultimately in my head, like I will price the business based off where I think it should be priced, irrespective of like where the founder comes in at. I guess like the slight kind of conflict is when they've raised some capital on the term that they're trying to set from like other angels who may be a little bit valuation insensitive compared to me when I'm trying to like manage a portfolio construction strategy. So I mean, I'm ultimately going to kind of like price the business as I deem like best fit based off where the business is at. But yeah, I mean, I see it both ways where like founders come with a valuation mind or they just come with a fundraise and ultimately like have to find a lead who will kind of dictate the valuation.
In that case, is it common for a founder to accept the lower valuation even when they have raised, say, a third or half of that round at a higher price?
Yeah, so there's a clause in venture called an MFN, most favored nation clause, and so if you are raising on a safe or a convertible note, right? It's not a priced round, and you give all of your investors, your angels, an MFN within their safer convertible note, and then then an investor comes in and wants to lower the valuation. With an MFN, you have to give the more favorable term back to those angels who had already signed the save for the convertible note on the higher valuation. So it just depends on like the founder. Like again, if you give MFNs, you're legally contracted to make that change. If you don't give away an MFN to those early angels and someone comes in like myself and asks for a lower valuation, I mean, you could take money from me at a lower valuation and keep those angels on a higher valuation. Technically, it's not illegal, but it's probably morally not the best thing to do. So like I would always recommend as the founder, like even if it means a little more dilution, like respecting the angels and the family and friends and giving them the same price that you're giving the institution. But it's not mandatory again unless there's that MFN clause within the notes and safes that your angels and family and friend investors are signing.
Yeah, fair enough. All right. Well, Dan, thanks so much for
Yeah.
taking the time. Anything else that you want to get out there about valuation or choosing early stage opportunities that we didn't touch
Yeah, I
on?
mean, I just think generally, and I guess this is like, I'm empathetic to like how challenging the capital raising environment is. And so it's obviously like easy for me to say this on the investor side, but I just feel like at this stage, because capital is so scarce in the early days, like try not to make valuation the reason why people end up having an excuse to pass on your business. Like, if they're giving you like real feedback about why they don't feel super confident in your business and that's why they're passing, like that's valuable and at least you know like what you need to work on and what you need to tweak. But if all of these investors are passing on your business and they're using valuation as an excuse, I mean, take that as real feedback and lower the valuation just so you at least have a chance to raise capital from investors who then can evaluate your business on its merits versus just a price. So that would be like number one, and first and foremost. And I'm just seeing so many great founders that I actually have awesome conversations with, just like come out with numbers that are just quite honestly like quite unrealistic, and it's a bummer because then I don't really have like the desire to go super deep on the business because my time is so limited. I know I'm not going to get there on price. So yeah, that would be kind of my feedback. And I think over time too, like if you have great investors long term and you feel like you've been diluted quite a bit because of the early stage terms, like great investors will, approve options being taken out of the option pool to kind of boost your equity into a higher position if you're feeling like you don't have enough of it as you're growing the business. So yeah.
Good advice. So thank you for laying all that out. And before we go, maybe just a preview. I think I heard Fund Two might be coming along. Is that something you could share, or is that a
Yeah, not a lot to share yet. We're still deploying Fund One, but yes, we intend to in the next year or two go out and raise a second fund, Habitat Partners Fund 2. We're really excited to continue doubling down on great founders in the earliest stages of both CPG and software. And yeah, that's something to come in the future, but not much to say quite yet.
All right. Well, we'll keep an eye out and we'll be following. So thank you so much for joining and appreciate all the insights and advice.
Thanks so much, Kyle. I really enjoyed it.